$1,000 car payments on the rise. Right now, 17% of auto loans have over $1,000 car payments. Jamie Dimon, the CEO of JP Morgan, just said that collapses in the car market could lead to broader problems in overall markets. And to make matters even worse, we're going to have price hikes that are actually coming from tariffs. We have a debt bubble right now in the car market, and it's becoming an absolute nightmare for the average car buyer. And what it says is 10 years ago, it was actually only 2.4%. This is a massive affordability problem. What we know that over 80% of car buyers right now are payment buyers. So if those payment buyers are signing up for over $1,000 monthly car payments, what are they going to have money left over to spend on? Everything in this market, everything in the economy is going to get weaker when you have everyday travel needs that are costing over $1,000 every single month. Repos are now up 20% year over year. We are now approaching levels that we haven't seen since the Great Recession. So repos just hit a new high, right? We're up 20% year over year. And here's the thing, last year it was already bad, and now we're 20% worse than where we were. We are now at the same point as we were back in the Great Recession. But think about what was going on during that time period. People were losing their house. Massive layoffs were occurring. Stock market was crashing. None of those things are happening right now. So what do you think is going to happen if we throw in some economic slowness, if people start to lose their jobs at a higher clip, if the stock market starts going down, if housing starts to flip over, if we have big time credit concerns, which we're already hearing a lot, if we go into a recession? Depends on who you ask. We're already in a recession. Here's the thing. All I'm saying is that we have a baseline right now that doesn't seem all that bad on paper. But if things get a little bit worse, we are already at a horrible point. We're already at the same point that we were back during the Great Recession. The Great Recession, that was the name of it. That's where we are right now in the car market. And stock market is at all-time highs. This is a massive, massive point of concern for everyone that's in the car market, everyone that's thinking about selling a car, thinking about buying a car. If you have any kind of job that's tied to the car market, all of this is all bundling together. It's all spring loading right now. There could be massive, massive problems on the horizon, and this is setting up very closely to what we saw with the credit concerns in the housing market during the Great Recession, except now it's starting with the car market. So lately, banks have actually been tightening up on the floor plans that they're giving to a lot of these dealers, and what a floor plan is basically a credit card that a lot of these dealerships can swipe to be able to purchase their inventory. They finance all their inventory. They don't pay cash for it, and probably a lot of this stems from Tricolor, who just went bankrupt. They had over 65 locations that went under, and what they were doing is they got into a desperate situation. They needed money, so they were actually double counting a lot of their collateral that they had to offer to these banks. And what happened was, okay, now we see this big crack in the system where credit is a big time problem for a lot of these dealers. It's going to make these banks actually focus in and look at the other problems that they're going to have. And when they see that, what do? Well, we're already seeing it. They're tightening up on their lending. And in a lot of cases, these dealerships, they don't have any money. So if you get tight on their lending, well, it's fewer cars that they're able to buy. If they're able to buy fewer cars, well, they're able to make less money. And then we're going to see more and more problems start to surface here in the car market. Credit is a big time problem. It all starts with the dealers. So Jamie Dimon, who is the CEO of JP Morgan, just said that collapses that we see in the car market right now could lead to bigger trouble in the broader market. And what a quote that I actually want to pull from him is that he said, when you see one cockroach, there are probably more. Now the cockroach that he's pointing out here is Tricolor. Big car dealership that actually went under because credit was a big time problem. And now what Jamie Dimon is pointing out, that okay, that was one situation where they were over collateralized. They were in a situation where they would never be able to get out from underwater on the loans that they have actually taken. And you're going to see a lot of other dealerships that are going to be in a similar situation. This is what Jamie Dimon is talking about. And then what we're talking about here is a lot of these big banks are actually hooked up with a lot of these dealerships that are over collateralized right now. So there's going to be a lot of banks, when they start digging into their numbers, they're going to see that they're going to be losing a ton of money. And this is what Jamie Dimon is talking about, where it can affect the broader market, is because when you take a lot of losses from the car market and then take them to the banks, well, then the banks have to tighten up. Then maybe the banks can't get into real estate as much as they want to. Maybe they can't write as many loans. They're going to start turning away. They're going to tightening up. When you tighten up an economy that lives and breathes and dies on credit, then what's going to happen when you start taking that credit away from them? The credit's like air in our economy right now. If you start taking that away, what's going to happen? Well, the economy dies. This is what Jamie's talking about. Big time problems. We're starting to see the cracks in the car market, and it could expand out to every other market out there in our economy. And what we're seeing right now is banks across the board are actually tightening up their lending in the car market, except for Wells Fargo and Ford. They're actually going the other way. This has got to end well, right? And what we're seeing is that right now, a lot of these banks are actually tightening up, meaning that they're not giving out as many loans as they were. They're not allowing lower credit scores to actually get auto loans. But here's the thing. Here's what's very interesting. We have two corporations that are actually going the other way. We have Wells Fargo, who actually are increasing their LTVs for people with lower credit scores. Absolutely insane right now in this environment. And then we have Ford, who is actually opening up who they're approving to get like F-150s. Now, I can understand from Ford's side, Ford Financial, because, okay, they're having a problem with an overstock in these F-150s, overrunning a lot of these dealerships. If you allow more customers to actually get loans, get approved on these F-150s, then you can actually get more metal moved. I understand that. I don't agree with it. I think you're setting yourself up for a disaster, but it makes sense there at least, right? We can connect the dots. With Wells Fargo, I have no clue what they're doing. I know that in their last quarter, it looked like their auto loans, maybe they took their foot off the gas because they saw some problems, and now they have to increase their loan book on the auto loan side. But here's the thing, this is not the way you do it. When we're experiencing right now the highest level of auto loan delinquencies that we've ever seen, when we're seeing repos go up 20% year over year, now you're going to soften up who you're allowing to write an auto loan to. Now you're actually increasing the value so dealers can charge way more than what the car is worth, and then you write the loan on it? Wells Fargo, what are you doing? This seems absolutely ridiculous. Ford, what are you doing? Seems absolutely ridiculous. Stop causing all these problems with your lending. We are in a credit bubble, and this is a good example of how banks, how lending institutions, how manufacturers can make things worse. So we're seeing now that a lot of dealers that are buying things wholesale, going to auctions and buying things, they're actually focusing more on inexpensive vehicles, because the top tier of vehicle right now, the ones that are very, very expensive, well, they're just not moving. And here's the thing, I'm a used car dealer and I sell cars that are $5,000 and under. This hurts me, and this hurts me greatly, because this is a market that I'm already in. Now, a lot of these top tier dealers, they're not going to go from selling 2-year-old used vehicles down to what I sell, 10, 15-year-old vehicles that they can sell for $3,500. They're not going to that. But all this trickles down, and it trickles down to me, and it can hit me in a major way, because the majority of dealers out there are in that mid-tier range. That $5,000 to $15,000 range is where most small used car dealers find themselves buying and selling vehicles. So if you have a lot of the top tier dealers that are buying the 2- and 3-year-old vehicles that are actually dropping down to even 5- to 10-year-old vehicles to be able to sell more affordable cars to their customer because their expensive stuff's not moving, well, then you have that mid-range of buyer at these auctions, this mid-range of dealer at these auctions, they're coming in and buying a lot of my stuff, and that's shoving the price of my stuff up. So it could be that I actually get snuffed out of this market, and it's a place that I don't really want to be in. So I need these dealers to stay out of my honey hole, to stay out of the place where I can go and buy these cars I can sell for $3,500. If a lot of these mid-range dealers actually tear down and start buying a lot of that stuff, well, those cars that I could buy for $2,000, $2,500 and sell for $3,000, $3,500, now they start costing $3,000, $3,500 at the auction, and to make money on them, you have to sell them for $4,500, $5,000, and that's not a scenario that I want to be in. We've already lived that. We went back there, back in COVID, I had to do that. I hated it. And what happened was I wasn't just going, I just stopped buying cars that I had to price way over what they were actually worth. And what do? Well, our sales actually tanked here at my car dealership. If we go back to a situation where we have more of those mid-tier buyers getting into my stuff, it could be a nightmare for us here at my car dealership. It's not one I want to relive. So listen to the stat right here. 28% of trade-ins have negative equity right now, and an average amount of $6,900. And even worse, 25% of those that have negative equity are underwater by over $10,000. That's absolutely insane. 28% of trade-ins right now have negative equity, and they have an average of about $7,000 that they're upside down. And what's even crazier is 25% of those people are upside down by over $10,000. And what's happening? Well, now we're starting to feel the crunch that we experienced during COVID, where all these people were paying either MSRP or $5,000 to $20,000 over MSRP. And now, as the market has corrected itself and we're getting back to where new vehicles can be bought under MSRP, well, it's those who bought 2 and 3 years ago that are actually suffering right now. And a lot of those people who were foolish to pay a lot of these market adjustments, well, they're also ones that will trade in their car and upgrade every 2 to 3 years. This is the cycle that we're in right now. All those foolish people that spent, well, now it's their turn to go buy a new car again. This is what they do every 2 to 3 years. So now when they're going to these dealerships and they're taking their Kia Telluride that they paid $20,000 over MSRP for, and they're taking it in and say, okay, well, we still owe $50,000 on this car. What can you do? Well, the car is only worth $30,000. What are you going to do about this $20,000 of negative equity? Well, we were hoping to just trade it in and be able to roll into our next car. Well, there's nothing that these dealerships can do about $20,000 of negative equity. Now, traditionally, there's always been negative equity in the car market. It's just the problem right now is the amount and how much, the quantity of people that are coming in with it. And there's not a lot that these dealerships can do. They can't lease these customers out of $20,000. They can't make it up in the back end of for $20,000. There's nothing that these dealerships can do. Usually, they'd be able to roll it into something else or lease them out of it and be able to get them on in the next car. They can't do it right now, so these dealerships are having to turn away these customers with so much negative equity. And these customers, they don't have money to begin with. You know, when they're paying $20,000 over market and then trading their car in every 2 or 3 years, they're probably not the best with money. So this is the situation that they're in. It's the customer's fault for signing up for it. It's the dealerships for adding all these adjustments on it. It's the bank's fault for actually allowing these loans to occur. And at the end of the day, it's the government's fault for pumping all this money into the system too, right? And we just had CarMax, who is the largest used car dealer in the US right now, actually have a disastrous quarter, and a lot of experts are calling their last quarter a canary in the coal mine for the car market. So we just had CarMax that reported their earnings. They were an absolute disaster, right? Their stock sold off by 20%. Year to date, their stock's down by about 50%. This is what the car market actually looks like right now. They're the largest used car dealer in the US. Their stock's down by 50%. This is how bad the used car market is right now. And I want to dig into one number that they actually talked about that is very, very worrisome for anyone who's holding any kind of assets. Me, who's holding any kind of assets in the used car market. In just 1 month, they said that their used car values went down by $1,000. That is a ton of money. Think about how many cars that CarMax has. Drop all of those cars by $1,000 and multiply by that. That's how much money that they lost in just 1 month in just vehicles that are sitting on their lot. If I had to do that here on my lot, I don't have a lot of cars. That would be a lot of money for me, and I'm very small. I'm not a massive corporation like CarMax. Here's the thing. This is just to show how bad the car market is, how volatile the car market is, how volatile pricing is. I can see it here at my car lot that I can buy something for $2,500 1 month, and then the next month that thing's going for $1,500. This is how quickly the car market moves. For us, we have to price aggressively and we have to change our prices aggressively. We want to stay with this car market. Big corporations like CarMax in a volatile market, they're going to be stuck between a rock and a hard place. They can't make quick movements like me. I make the decision, I snap my fingers, prices are lowered. They can't do that. So here's the thing, a lot of these auto manufacturers, they were planning on eating a lot of this tariffs that were going to be baked into the products that they actually make. But here's the thing, they're not going to be able to do it for much longer because it is actually eroding their margins. All of these companies, they're all publicly traded. What do stockholders need to see? They need to see really good margins. And if everything is costing all these companies a lot more because of tariffs, either they figure out ways to be able to produce their product products cheaper, or they have to pass it on to you, the consumer. And a lot of these manufacturers, we're already seeing reports, even though demand is weakening, we're actually seeing prices that go up. This is not going to work out well for the car market, for these manufacturers, for these dealers, for the economy overall.